So when you listen to a corporate earnings call, I think there's this expectation of just total transparency.
Yeah, you definitely expect it to be straightforward.
Right.
Right.
Like you think you're reading a blueprint. The numbers go up or, the numbers go down.
Exactly. The CEO just points to the ledger and says, well, there it is. Profit or loss. Just clean math.
Clean math, exactly. But when you really step into the world of executive communication, that pristine blueprint looks a lot more like a funhouse mirror.
Oh, absolutely. It's a landscape of spin and, omissions.
Yeah, carefully constructed narratives. And that brings us to the focus of today's deep dive. We're looking at Ryanair's CEO, Michael O'Leary, back in May of this year.
Right, his famous victory lap.
Yeah, the stock was sitting around like 22 to 23 euros a share, and he pitched this to investors as just this incredible advantage.
He basically begged them to buy it.
He did. He essentially said, don't come crying to me in 2 years wishing you'd bought the dip.
Yeah.
Because here's the dip.
But then you fast forward just 8 weeks, this 2 months, to their July first quarter update. And the floor had completely fallen out.
It really did. Profits plummeted 34%.
Yeah.
So that is the crux of what we're analyzing today, using our source material, the gap report. We're giving you a sort of decoder ring. You don't need to be an aviation geek or a Wall Street trader for this.
No, not at all.
We want to show you how to spot narrative shifting in any industry. We're comparing that highly optimistic May call with the, frankly, much bleaker July update.
Because it is fascinating to watch a management team pivot from begging the market to buy the dip to, explaining a massive profit collapse, all in the span of 2 months.
Right. But to understand where they're spinning the narrative, we kind of have to establish their baseline of credibility first, don't we?
Yeah, you have to. Because they aren't just making things up out of thin air. When things go right for Ryanair, the numbers speak for themselves. And honestly, they are formidable.
So let's break down that promises kept column first. Because the foundation they built is massive. Like in May, they told the market they were going to repay a 1.2 billion euro bond.
And they executed on it. They did it.
Yeah, making them effectively debt-free.
Yeah.
By June 30th, they were sitting on 2.8 billion euros in gross cash.
Which is impressive. But the physical assets are where their real structural advantage lies.
Oh, the planes.
Right. They have 620 Boeing 737s sitting fully unencumbered on their balance sheet.
Meaning they own them outright, like no bank loans, no monthly lease payments at all.
Exactly. And that distinction matters so much in the aviation industry because a vast majority of airlines lease a huge portion of their fleets.
Right, which is a fixed cost.
A relentless fixed cost. If demand drops and you have to fly your planes half empty, well, you still owe the leasing company the exact same amount of money every month.
Which just burns through cash reserves, I'd imagine.
Incredibly fast. But by having those 620 unencumbered aircraft, Ryanair just removes that fixed monthly chokehold.
Yeah, the CFO called it a fortress balance sheet.
And structurally it is. It lets them survive market downturns that would absolutely bankrupt a highly leveraged competitor.
Right. It's like a friend paying off their mortgage and all their student loans on the exact same day.
Yeah.
But they also have 620 fully paid off cars sitting in the driveway that they can just use to make money whenever they want.
That's a great way to put it. And they are generating that revenue. Traffic grew 6%. They hit over 61 million passengers for the quarter.
Yeah, they opened 3 new bases too. Rabat, Tirana, and Trapani.
Plus, we have to look at their capital allocation, the share buybacks. They hit their 750 million euro target.
Which is huge.
90% complete at an average price of 26 euros and 35 cents.
I was actually looking at the historical data on that in the report.
Yeah.
They have retired nearly 40% of their issued share capital since 2008. So for an investor who just held the stock that entire time, their slice of the pie has almost doubled in size without them having to buy a single additional share.
Which is just a textbook demonstration of financial control. They manage debt, expand the footprint, and return capital. When they promise something mechanically within their control, they deliver.
They do.
Yeah.
But, and this is where the logic breaks down for me, if the foundation is this incredibly strong, zero debt, massive cash reserves.
The fortress.
Right, the fortress. Why was the CEO on television in May desperately pitching the stock as a dip? Like, if I have a paid-off mortgage and millions in the bank,
Yeah.
I don't go on a press tour begging people to notice how undervalued I am.
Right. It feels a bit desperate.
It feels defensive.
Okay.
What were they seeing on the horizon that they were trying to distract us from?
Well, you're hitting on the friction point between a solid balance sheet and a highly volatile daily cash flow mechanism.
Worse.
Exactly. The fortress balance sheet is just the foundation, but fares are the oxygen. You still have to sell the seats at a premium to actually generate a quarterly profit.
And the goalposts on those fares shifted dramatically. I mean, in May, management pitched summer fares as broadly flat, and O'Leary specifically said there was nothing but upside.
Nothing but upside.
Right. But by July, first quarter fares were actually down 6%, and the second quarter was guided down to mid-single digits. That's the shift that triggered that massive 34% profit decline.
Yeah, and we have to look at the business justifications they offered for this drop. They cited this confluence of macroeconomic and geopolitical factors.
Right.
They specifically pointed to the breakdown of the Middle East ceasefire, general consumer hesitancy, and the U.S. resuming bombing in Iran.
And just to pause here and be clear for our listeners, we are neutrally reporting management's stated business justifications here.
Right, taking zero political stance on these global events ourselves.
Exactly. We're just analyzing this strictly through the lens of corporate communication, looking at how they explain revenue drops.
And those geopolitical headwinds do genuinely impact travel demand. But the analytical value comes from observing how management structures their defense around them. They fall into this pattern of, well, narrative inertia.
Narrative inertia.
Yeah.
I noticed this when comparing the transcripts from both calls. Like, in May, Ryanair admitted there was some early weakness in bookings.
Yeah, they did.
But they told investors not to worry because close-in bookings, people buying last-minute tickets for a premium, those were trending strong and would save the quarter.
That was the thesis. Close-in bookings are the parachute.
But the parachute didn't open. Fares dropped 6%. Yet in July, when analysts asked why the second quarter was also looking weak, management used the exact same argument.
They recycled it.
Yeah, they said, yes, things look soft now, but close-in bookings will recover. Isn't this just the corporate version of Charlie Brown and the football?
Pretty much, yeah.
Why would financial analysts, who are paid to be skeptical, accept the exact same excuse in July that just resulted in a 34% profit drop?
Well, because management is highly skilled at softening the blow with hyper-specific positive operational data. They don't just offer the recycled excuse in a vacuum. They surround it with metrics that reinforce that fortress narrative. Like, look at how they handled the unit cost discussion.
Right, because fuel costs were staggering. Unhedged jet fuel basically doubled to $151 a barrel in Q1.
Yet somehow, Ryanair managed to contain their overall unit cost increase to just 5%.
Which is wild. How is that mechanically possible when your main operating expense doubles?
It comes down to operational leverage and fleet modernization. They're taking delivery of newer Boeing MAX aircraft.
Which burn less fuel per seat. Right?
Exactly. And they're also just highly efficient at increasing load factors, meaning they fill a higher percentage of seats on every single flight. So if you burn more expensive fuel but spread that cost across more paying passengers on a more efficient engine,
you suppress the per unit cost increase.
Exactly. And once they established that 5% metric, they immediately pivoted to attack their rivals.
Oh, right. They boasted that their costs are 81% cheaper than Wizz Air.
And 150% cheaper than EasyJet. It's a strategic redirection. They're essentially telling the analysts, look, do not look at our falling ticket prices. Look at the widening gap between our survival timeline and our competitors.
So if they convince the room that a downturn will devastate EasyJet or Wizz Air way before it hurts Ryanair, the analysts become more forgiving of the close-in bookings excuse.
Precisely. The logic is, even if the parachute fails again, Ryanair still hits the ground much slower than anyone else.
Okay, but if management is aggressively recycling old excuses for the things they're forced to talk about, it makes me wonder about the things they just quietly delete from the conversation entirely.
Oh, the omissions.
Yes, the disappearing acts. Because the omissions feel much louder than the talking points.
They usually are. Omissions are often the most accurate indicator of internal corporate anxiety.
Take the CEO's contract extension. In May, this was treated as a massive institutional victory. It was featured prominently in the prepared remarks. They were extending O'Leary to 2032, tying him to 10 million shares based on very aggressive profit targets.
A huge deal.
Right. They specifically said board engagements with institutional shareholders would start in the coming days. But in July, Total silence.
Nothing.
Not a single mention in the prepared remarks. No Q&A mentions.
Yeah, when an active high-stakes agenda item just vanishes from public conversation, it's a tactical retreat.
Right, because asking for a massive bonus looks terrible alongside a 34% profit drop.
Exactly.
Is it just a PR retreat, or are negotiations stalled? Because the shareholders who might have rubber-stamped it in May are suddenly going to ask uncomfortable questions in July.
Oh, they definitely read the room and buried the topic to avoid a public confrontation. And, they performed a very similar disappearing act with their macroeconomic predictions.
Right, the macro resolution thesis. In May, O'Leary made this super bold geopolitical forecast. He predicted that the U.S. midterms, which he claimed kicked off around Memorial Day, would force Donald Trump to resolve the Strait of Hormuz conflict by the end of May.
Which is incredibly specific.
Very. He gave the market a timeline for a catalyst that would drive travel demand back up. But by July, that prediction completely evaporated.
Because setting a hard deadline in geopolitical forecasting is inherently dangerous for a CEO. May came and went, the conflict didn't resolve, the catalyst failed.
So instead of updating the thesis, O'Leary just vaguely called the current era an aberration, like 9/11 or the Gulf War. He said it will eventually pass. The Memorial Day timeline was just dropped down a trapdoor.
Right. In May, they needed urgency. A specific event by Memorial Day gives investors a reason to believe the stock dip is temporary, so they buy.
But when it fails,
Acknowledging that damages credibility, so they broaden the horizon. A specific missed deadline just becomes a generational aberration requiring long-term patience. It's narrative sleight of hand.
it's like a magician making you look over here while hiding the truth over there. We saw that exact same sleight of hand with their fuel hedging. Let's talk about that because the spin here was amazing.
Yeah, so fuel hedging is essentially an airline buying insurance against volatile oil prices.
Nice.
You have the spot price, which is what fuel costs today.
Right.
And then you have the forward rate, which is a contract locking in a specific price for fuel you'll use in the future, like in 2028. You pay a premium for that certainty.
Okay, and in May, they explicitly stated their 2028 fuel was entirely unhedged because they were waiting for forward rates to drop below $80 a barrel.
Right, framing their patience as highly disciplined.
But by July, the geopolitical landscape pushed those rates up, not down. So they announced they locked in 15% at $85 a barrel.
Yeah.
Which is well above their 2027 rate of $67 and misses their sub-80 target from May. Yet they spun the $85 lock-in as opportunistic.
Yeah, they reframed a strategic miss as a tactical win. The market moved against them. They probably panicked mildly and locked in a small portion at 85 just to stop the bleeding in case it hit 100.
But a CEO can't just get on a call and say, hey, we misjudged the market.
Exactly. So they claim they took advantage of minor price weakness on a specific day. It might be technically true relative to the spot price that afternoon, but it completely ignores that they failed their primary objective from 2 months prior.
It's like buying flood insurance when the water is already in your living room and bragging to your neighbors that you got the policy before it reached the second floor.
That is the perfect analogy. And so when your past predictions vanish and your fuel hedging misses the mark and profits are down 34%.
You're standing in front of analysts doing the math.
Right. To survive that, executives have to play aggressive defense. They dictate the conversation before analysts find the weak spots. They preempt narratives.
Which brings us to the Thessaloniki incident. Just 10 days before this July call, a Ryanair flight had a fan blade failure and depressurization. A pregnant passenger went to the hospital.
Right. And the National Transportation Safety Board, the NTSB, takes over that investigation. Their preliminary report usually drops in about 28 days.
And normally, standard corporate protocol is just strict neutrality, right? We're cooperating, we can't comment.
Exactly.
But O'Leary gave this unusually long, preemptive defense before anyone even asked. He specifically stated, twice, this has nothing to do with aging aircraft.
Yeah.
The plane was 18 years old. That's like me walking into a room and immediately yelling, I didn't break the lamp.
Yeah.
Before you even notice the lamp is broken.
A double denial like that is a massive psychological tell.
If the NTSB is leading the investigation, isn't preempting the findings with aggressive, unprompted denials a massive gamble? What if the report in 28 days says it was related to age?
It's a huge calculated risk, but it shows how deeply management fears the aging fleet narrative. The whole pitch rests on that fortress balance sheet, those 620 unencumbered planes.
Right.
If analysts start believing those planes are too old and prone to failure, it implies Ryanair needs massive capital expenditure to replace them. That destroys the fortress narrative.
Ah, so he has to stomp out the spark.
Exactly, before an analyst turns into a fire. And when you're playing aggressive defense, it helps to have a common enemy to unite the room against. So they use the EU.
Oh, the EU regulatory monologue. Ryanair complaining about the EU is basically a quarterly tradition, but this was a brilliant clock management tactic.
It really was.
They complained bitterly about a new EU rule requiring airlines to advertise a fare inclusive of 2 free carry-on bags, because Ryanair advertises a €29 seat and upsells baggage later. Now it has to look like an €89 ticket up front.
Right, and O'Leary railed against it, saying it's unfair because 50% of passengers opt out of the second bag anyway.
But amidst all that outrage, the CFO quietly admitted the rule is revenue neutral, because consumer behavior doesn't change.
They pay the same checkout price regardless.
Exactly. So if it doesn't affect the bottom line, why dedicate so much premium time to it?
Because it constructs a villain. It focuses the analyst's attention on an external injustice rather than internal revenue failures. It eats the clock.
Just distraction tactics,
Yeah.
like the EasyJet M&A and CFM engine stuff?
Yes, they started offering highly detailed, completely unsolicited commentary on the future of EasyJet, running through scenarios about venture capital and private equity acquiring them.
And claiming Ryanair wants absolutely zero EasyJet assets. And in the same breath, they announce a new specific engine shop MRO partnership with CFM.
Right. And MRO maintenance, repair, and overhaul is a critical choke point right now due to a global parts shortage. And Ryanair made a huge point that this new shop won't take any third-party work from other airlines.
Wow. So they're projecting absolute dominance, signaling that their planes will fly while competitors sit in hangars waiting for parts.
By controlling the conversation with EasyJet mergers and exclusive deals, they define the battlefield. They look like kingmakers. It makes it incredibly difficult for a junior analyst to interrupt a sweeping monologue about European consolidation to ask a nitpicky question about falling summer fares.
It's a verbal smokescreen built out of legitimate but secondary business data.
Exactly.
So as we wrap up, what's the core takeaway here for someone listening? Because true financial literacy isn't just about reading the numbers on a slide.
No, it's about tracking the narrative gaps. You have to measure the promises and firm timelines hyped last quarter against what is being discussed today.
When the macro excuses stay the same but profits drop 34%.
Right. Or when a massive compensation package quietly vanishes, that is where the reality of the business actually lives.
You have to look at what leadership rushes to deny and what external villains they point at to run out the clock.
And that actually brings up one final sneaky detail buried deep in the Q&A of the July source material.
Oh, the net income target.
Yes. Historically, when discussing net income per passenger, management firmly anchored the target at 12 to 14 euros.
But late in the call, when pressed on long-term profitability, O'Leary casually stated the profit movement is, quote, 12 towards 14 to 15 euros a passenger.
He just seamlessly slid a 15 into the upper bound.
Right. So we want to leave you with this provocative thought to ponder. Was that just an accidental slip of the tongue by an optimistic CEO?
Or is he subtly seeding a brand new, completely unverified aspirational anchor to distract from the current profit drop?
Hoping that next quarter, analysts are so obsessed with hitting that 15 euro target, they forget to ask about the current mess.
The birth of next quarter's narrative inertia happening live on the call.
It really is an art form. So next time you are sitting in a company all-hands meeting and leadership points to a blueprint, keep your ears open. Pay attention not just to the numbers they want you to see, but to the shadows they're trying to ignore. Thanks for joining us on this deep dive. Keep asking questions.